Looking for a world-class business to invest in? Want to collect safe, growing dividend income that beats the market? Like the idea of buying a stock after it's dropped 25%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a global apparel company providing millions of people with clothing and footwear. Apparel is a beautiful thing to invest in. It's obviously simple to understand. More importantly though, it's necessary. Can't very well go walking around without any clothes on. So, every human being alive is a potential customer. That simplicity and necessity means growing profits and growing dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of VF Corp, which appear to be trading at a significant discount today. VF Corp, stock ticker VFC, is a worldwide apparel and footwear company. Founded in 1899, VF is now a $27 billion by market cap apparel titan that employs more than 33,000 people. Some of VF's most important and recognizable brands include Vans, The North Face, Timberland, and Supreme. The Supreme acquisition closed in late 2020 for $2.1 billion. The company has three segments: outdoor, 45% of fiscal year 2021 revenue, active 45%, and work 10%. Revenue geography is nicely diversified. 50% of fiscal year 2021 revenue came from the US, the other 50% international. Channels are also diversified. Wholesale accounted for 55% of last fiscal year revenue, while the other 45% came from direct-to-consumer sales. VF has multiple clothing types for multiple clothing settings locked down. Whether it's for work or play, they cover it with high-quality options across their branded portfolio. And with their large DTC channel, they're already ahead of the e-commerce curve. They're providing products on their customers' terms. Apparel is one of my favorite business models to invest in. I say that because they're providing a necessary product to society. You can't go around without clothing and footwear, and while you certainly don't have to buy your clothing or footwear from VF, their brand strength gives them a leg up on a lot of the competition. Providing necessary products to an ever larger pool of global customers at ever higher prices is a recipe for ever higher profits, and that should naturally lead to ever higher dividends. Indeed, VF has increased its dividend for 48 consecutive years. They're a dividend aristocrat. Actually, they're a dividend aristocrat nearly twice over now. The 5-year dividend growth rate is 9%. And that high single-digit dividend growth is paired with the stock's yield of 2.9%. We're looking at a yield and growth combination that's in the double digits here. That 2.9% yield, by the way, handily beats the market. It's also 50 basis points higher than the stock's own 5-year average yield. The dividend remains protected by a payout ratio of 61.3% based on this year's adjusted earnings per share guidance. Great dividend metrics here. Looking at business growth, VF's revenue is basically flat over the last decade, moving from $9.459 billion in fiscal year 2011 to $9.239 billion in fiscal year 2021. Meanwhile, earnings per share actually fell substantially over this period from $2 to $1.04. I won't lie, these numbers are pretty ugly. However, I think it's important to properly frame this. First, VF spun off its jeanswear business in 2019. This spinoff, which is Contour Brands Inc., stock ticker KTB, is a $3.2 billion company on its own. This spinoff had the effect of immediately lowering VF sales in a material way. Second, and more importantly, the pandemic gravely harmed the company's revenue and profit in calendar year 2020. While that second issue is the more pertinent one, it's also the temporary one. Investors cannot and do not invest in the past. We're risking present capital for future rewards. And so as we move past the pandemic, the question becomes, how will VF perform over the coming years? Looking forward, CFRA is anticipating that VF will compound its earnings per share at an annual rate of 31% over the next 3 years. That's kind of an eye-boggling number, especially when you put it up against the last decade, but the last decade looks so bad only because of last year. Fiscal year 2021 was an aberration and not indicative of this company's true earnings power. I don't think it's unreasonable to expect huge growth numbers off of an earnings trough as the business fully recovers moving forward. To that point, VF is expecting adjusted earnings per share to be at least $3.20 this fiscal year. That would represent 144% year-over-year growth compared to fiscal year 2021 adjusted earnings per share. Moreover, the Supreme acquisition didn't complete until December 28th, 2020. This is a big brand that's growing faster than VF as a whole, and VF has stated that they expect this acquisition to be immediately accretive. When you combine an exciting, accretive acquisition with a strong recovery, VF is positioned to bounce back aggressively. While earnings per share growth could very well be well into the double digits for the foreseeable future, I don't think the dividend will necessarily grow at that same rate. I believe that VF will responsibly manage the dividend and continue growing it at a high single-digit range. That'd be right in line with their long-term history. With the near 3% yield, that should be more than enough to make shareholders happy. One last point here that I'd like to make is that VF didn't cut the dividend during 2020, even though business results temporarily collapsed. I think that really shows just how committed to the dividend this company really is. Moving over to the balance sheet, VF's financial position is good. I will say that the numbers here look worse than they really are due to the most recent fiscal year, seeing both the closing of a major acquisition and a large drop in EBIT at the same time. The long-term debt-to-equity ratio is 1.87, while the interest coverage ratio is slightly over 4. I think the latter number will improve markedly over the next year or two as earnings normalize. Profitability is robust. Over the last 5 years, the firm has averaged annual net margin of 6.81% and annual return on equity of 19.61%. I think profitability will also improve as we move forward and see the business recover. In addition, Supreme has better margins than VF as a whole, so the acquisition should put upward pressure on margins. I see a lot to like about VF as a long-term investment, and the company does have durable competitive advantages that include brand strength, global distribution, a multi-channel business, and economies of scale. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. There's integration risk with this large Supreme acquisition, although VF has a long history of successful acquisitions and integration. Vans, the North Face, and Timberland were all acquired. VF has some exposure to struggling B&M US retailers through the wholesale channel. Brand strength is something that has to be continually managed and marketed, so VF will have to properly maintain these brands moving forward. Fashion trends are highly changeable. The company must stay on top of trends to continue growing. Overall, I see these risks as fairly low. Yet with the valuation being so appealing after a 25% drop from its recent high, the possible rewards are very high. The stock is trading hands for a price-earnings ratio of 34. That ratio is artificially high because of depressed earnings. Even so, it's still lower than its own 5-year average of 35.2. The price-to-cash flow ratio of 19.1 is also well below its 5-year average of 22.6. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. That dividend growth rate is on the high end of what I ordinarily allow for, but I think this dividend aristocrat deserves the benefit of the doubt. It is below the company's demonstrated 5-year and 10-year dividend growth rates respectively, so I'm being somewhat conservative here. It's also quite a bit below CFRA's near-term earnings per share growth forecast. I think VF can properly balance a business recovery, which should result in double-digit earnings per share growth over the next few years, with growing the dividend at a level that's not far off from, but perhaps slightly below, their long-term average. The dividend discount model analysis gives me a fair value of $84.28. The reason I use the dividend discount model analysis is because the business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates VFC as a 3-star stock with a fair value estimate of $66. CFRA rates VFC as a 5-star strong buy with a 12-month target price of $80. I came in a bit high this time around. Averaging the three numbers out gives us a final valuation of $76.76, which would indicate the stock is possibly 13% undervalued. Here's the bottom line, guys. VF Corp is a high-quality apparel company with some of the best brands in its entire industry, with a market-beating yield, nearly 50 consecutive years of dividend increases, high single-digit long-term dividend growth, and the potential that shares are 13% undervalued. This dividend aristocrat looks highly worthy of attention, if not capital, right now. And now for a special news announcement. Air Products and Chemicals Inc. stock ticker APD has announced that it has signed agreements with Saudi Aramco and ACWA Power for asset acquisition and project financing of the $12 billion air separation unit, gasification, and power joint venture. It's JVs like this one that make me even more enthusiastic about Air Products and Chemicals over the long run, which is a stock I analyzed and valued in early August. If you haven't already taken a good look at this name, now might be a good time to do so. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.